everyone, my name is Siti Afrina binti Miskam. Today we are presenting Sun Summit Berhad as our target company and Kesom Berhad as its comparable company.
Hi, Assalamualaikum. Today I will start with the introduction about Sun Summit Berhad. Sun Summit Berhad is a big investment company listed on Bursa Malaysia. They started in property but now they also do healthcare, education, construction and retail. Their goal is to build sustainable environments for the community.
Comparison Company Overview. Kesom Berhad is a Malaysian property development company listed on Bursa Malaysia, established in 1986. The company is headquartered in JB, Johor, and has developed a strong presence in the Malaysian property market, particularly in the southern region of the country.
Okay, next, before we look at the graph, let's see the main numbers for the liquidity ratio. The current ratio in 2021, Sun Summit Berhad had a very high ratio of 5.61 to 1, but in 2023, it dropped to 2.22 to 1. For the quick ratio, this is for emergency cash. It was 4.35 to 1 in 2021 and dropped to 1.38 to 1 in 2023. For the comparable company, the current ratio, Kesom Berhad maintained exceptionally high liquidity with a ratio of 9.26 in 2020 and 8.46 in 2021. For the quick ratio, even when removing inventory, Kesom Berhad shows a steady increase from 2.87 in 2020 to 3.26 in 2021. The data shows that Sun Summit Berhad is operating within safe margins while the comparable company maintains a much larger liquidity buffer. Now, let's see at the graph for the current ratio. Good news, in 2021, the company was at its strongest because their assets reached 1.8 billion. The change in 2023, the ratio went down to 2.22. This happened because the company took on more short-term loans. The conclusion, even though it dropped a ratio of 2.22, is still good and above the industry safety mark of 2.0. For the current ratio comparison, Kesom Berhad has a very high ratio around 8.46 to 9.28. This is much higher than Sun Summit's 2.22. This shows that Kesom Berhad is extremely safe and has a lot of extra cash and assets. Next, the quick ratio. This test is stricter because it does not count inventory like houses or land that are hard to sell quickly. The ratio dropped from 4.35 to 1.38. This is because the company spent more money on property development. Is it safe? Yes, anything above 1.0 is considered good for a developer. Sun Summit still has RM155,000 in cash and bank. For the quick ratio comparison, even for the emergency cash test, Kesom is more stable, staying around 3.0. Sun Summit is lower at 1.38 because they are spending more on projects. Overall, Kesom Berhad is more stable while Sun Summit is using more of its cash to grow.
This dataset represents 5 years of profitability performance for our target company, Sun Summit Berhad, covering the period from 2019 to 2023. Sun Summit Berhad's gross profit margin has steadily declined from 48.72% in 2019 to 25.12% in 2023, indicating rising cost pressures, reduced pricing power over time. Net profit margin dropped significantly from 26.31% in 2019 to a low of 4.81% in 2022 before slightly recovering to 6.01% in 2023. It's suggesting tighter control over expenses but still below earlier profitability levels. ROE, return of equity, peaked at 15.01 in 2020 and fell sharply to around 2 in subsequent years, reflecting weaker earnings performance relative to shareholders' equity. Next, for comparison purposes, we analyzed 2 years of profitability data from Kesom Berhad, focusing on the financial years 2020 and 2021. In 2020, Kesom Berhad recorded strong profitability with a gross profit margin of 53.06, a net profit margin of 73.36, and a return on equity of 8.33. However, in 2021, all three ratios declined. Gross profit margin fell to 48.02, net profit margin dropped to 24.46, and ROE decreased to 3.67, indicating a significant reduction in overall profitability. From 2019 to 2023, Sun Summit Berhad's gross profit margin showed a consistent decline, falling from 48.72 in 2019 to 24.13 in 2023. The sharpest drop occurred between 2020 and 2021, when the margin decreased from 41.43 to 31.81. In contrast, Kesom Berhad maintained much stronger margins of 53.06 in 2020 and 48.02 in 2021, highlighting Sun Summit's weaker profitability and faster decline compared to its comparable company. Sun Summit Berhad's net profit margin declined significantly from 26.31 in 2019 to a low of 4.81 in 2022, before a slight recovery to 6.01 in 2023. The sharpest drop occurred between 2019 and 2020. In comparison, Kesom Berhad recorded much stronger margins, with 73.37 in 2020 and 24.46 in 2021, highlighting Sun Summit's thinner profitability and weaker performance relative to its comparable company. Sun Summit Berhad's ROE declined sharply from 13.55 in 2019 to just 1.24 in 2023, indicating a significant weakening in shareholder returns. The steepest drop occurred between 2020 and 2021. In comparison, Kesom Berhad also experienced a decline, but its ROE remained relatively more stable, highlighting Sun Summit's sharper erosion in value creation.
Okay, today I want to elaborate about some of two different companies, which is Kasum Berhad company and Sun Summit company. Which this is two company we need to have a comparable which is different in different ratio because we want to show which one the company is the best and which one have a high profit and something like that. So in my part, I have two efficiency ratio, which is I need to make a comparable between these two companies with efficiency ratio, which is I have 2:3 ratio. That's mean I have to asset turnover ratio and inventory days ratio. Also receivable days ratio. So in the part of the Sun Summit Berhad, we got a lot of this evidence, which is we have the asset turnover ratio that we know as a sales that we divide with the total asset. This asset turnover ratio we can know as like whether the asset can replace the revenue or not. Because if we buy the asset, we need to sell this part asset turnover ratio. The Sun Summit have a increase in 2019, which is 0.2535, and then decrease in 2020, then decrease in 2021, which is they can spend ringgit Malaysia 0.35 cents, like 0.35 cents, and same as 1 ringgit asset. So that's still high. Okay, then we move on to the inventory days ratio, which is this ratio get a have different days, which is this mean inventory days ratio is when we buy something, we must sold them because each inventory have a due date time, because sometimes the property, if we not sell at the time, the price will increase in next month or next years. So this in the Sun Summit ratio in inventory days, they increase in 2020, which is we can divide the inventory with the cost of sale and times to 395. So the next is the receivable day ratio. We move to the receivable day ratio, which is this ratio. Okay. How many the company receive collectible from the client, which is when the ratio lower, this means it's good for the company because they can collect earlier for the company. For example, for the Sun Summit Berhad, they can collect the cash from clients. Is from the Sun Summit Berhad, they can receive about in 32 in the 2019, which means that's good. Right. So, but in 2020, they increased to the 90 days. Faces the challenge, which is the pandemic COVID-19. So, customer may be delayed by their payments. This formula is we need to receivable account and divide by sales, then times to 369. So, next we have efficiency in the Kasum Berhad company, which is a comparison company of the Sun Summit. Okay, first one, they have an ratio, which is in this company we just comparable of two, just compare 2 year only. So this is efficiency ratio for the Sun Summit Berhad and the Kasum Berhad. So in this part, I will share with you how efficiently the company use that asset to generate their revenue. Like in 2019, they just used the asset turnover ratio to the 0.35 and then decrease over the year. But in 2023, they increased the asset turnover ratio, which is 0.2295. So that's mean they generate of RF 0.35 for every one of asset. So overall of this company is when they have a strong performance, because followed by the when they have a gradual recovery over the 5-year periods. So the comparison is shown that Kasum Berhad has a higher asset turnover ratio than Sun Summit use their asset more efficiently to generate revenue. If you can look, this difference is so big. This line of the blue color line, which is the Sun Summit, but this is orange color with the Kasum Berhad. So this is like in both company in 2021 there's a decrease ratio, this ratio, because due to COVID-19 impact to the property market. Next is the inventory days ratio, which is this. You can see this graph just increase and decrease. So in 2020, this ratio was increased for the Sun Summit because also what I said previous time, this is the during COVID-19 on the 2020, they increased the inventory days to 968 days to pay. They sold the property. So, but in 2023, the performance continued to improve, showing the better inventory management, because the years they show just 454 days only to take the inventory days ratio. But so you can see, in contrast, the inventory days ratio on the Kasum Berhad is a big deal. Like wow, this is big, because from the 988 to 1,997. So this is an improve over this ratio. How quickly the company collect cash from the customer, which is in like usually in 2019 they just use 32 days to collect their cash from their client or customer. But in 2020, they increased to 90 days to collect it. Because to collect this, we need to collaborate with the clients and the customer, because if we don't have a contact with them, we cannot push them to pay the payments like that. But overall, the Sun Summit company show a strong, consistent improvement in collection receivable, because in 2023 they increased the receivable days ratio to 46 days only. But in this receivable day ratio comparable with the customer heart which have higher days to take to collect the cash from the customer and client, which is in 2021 they increased to 147 days. So that's so long time to fix. So that's all for this. So for the conclusion is, I want to conclude one thing. The receivable days ratio show that how long the company can working is. The Sun Summit improved the reducing credit time from 90 days to 67 days, which is showing the better credit management and better customer. But also, this is just increased 69 days to 147 days. This is indicating to slow cash collecting and potential cash flow issue. So both companies struggle during the pandemic because it's a very hard time to business to grow up. But the Sun Summit performance is better in managing the receivable from me and the receivable from my part. Thank you. Okay, and forget to introduce myself. My name is Gloria Samban Andrew, and this is the account and finance subject for the real estate student. Thank you.
Hi, my name is Ishwariana Murugan, and I'll be presenting the solvency or carry ratio. For this slide, we'll be looking into the Sun Summit Berhad. First table is debt to equity ratio, and second table is interest coverage ratio. First, we'll look into the debt to equity ratio. The formula for this ratio is total debt divide total equity times with 100%. Both debt and equity, we will get it from the financial statement of the company. To get the total debt, we will be adding short-term borrowings and long-term borrowings. Debt to equity ratio measures how much the debt company uses compared to shareholders' equity. From 2019 to 2021, the ratio remains low for Sun Summit Berhad, especially in 2021 at only 5%. This indicates a very conservative capital structure with minimal financial risk. However, in 2022 and 2023, the ratio increases significantly to 46% and 59%, showing higher reliance on debt financing. An increased debt to equity ratio means higher financial leverage and higher risk, while lower ratio indicates stronger financial stability. Overall, Sun Summit Berhad shifted towards more aggressive debt strategy in recent years. The second table is interest coverage ratio for Sun Summit Berhad. The formula for this ratio is earning before interest and tax divided by the finance cost or interest cost. This table shows that how a company measures the ability to pay interest expenses using its operating profit. In 2019, the ratio is very strong at 32 times, showing excellent ability to cover interest costs. From 2020 onwards, the ratio declines steadily to around 2.7 times in 2022 and 2023. A decreasing interest cover ratio indicates rising interest burden and reduced safety margin. Although Sun Summit Berhad can still meet its interest obligations, the downward trend signals increasing financial risk. Now we'll look at solvency or carrying ratio for comparison company, which is Sun Berhad, for 2 years, which is 2020 and 2021. The first table, which is debt to equity ratio, measures the proportion of debt used related to shareholders' equity. In 2020, the ratio is 10.09%, indicating a low reliance on debt financing. In 2021, the ratio decreases slightly to 9.46%, showing a further reduction in leverage. Overall, the declining debt to equity ratio suggests a conservative capital structure and a low financial risk. The second table, which is interest coverage ratio, measures the company's ability to cover finance costs using operating profit. In 2020, the ratio is negative due to finance costs being reported against operating profit, indicating an abnormal or weak coverage position. In 2021, despite operating losses, the ratio improved to 10.13 times, suggesting finance costs were manageable. Overall, the fluctuation reflects instability in operating performance. Now we will look into the analysis of debt to equity ratio for Sun Summit Berhad and Kasum Berhad. For the first graph, we can see how Sun Summit Berhad debt in equity position changes over 5 years. At the beginning, the company operates with relatively low leverage in 2019 and 2020, showing that equity was the main source of financing and financial risk was well controlled. In 2021, the ratio dropped to its lowest point, which suggests the company significantly reduced its borrowings or strengthened its equity base. This indicates a very conservative financial position during that year. However, from 2022 onwards, the trend reverses sharply. The debt to equity ratio rises strongly in 2022 and continues increasing in 2023. This shift shows that Sun Summit Berhad started relying more heavily on debt financing, possibly to support expansion or new investment, but at the same time increasing its financial risk. The second graph compares the capital structure of Sun Summit Berhad and Kasum Berhad over 2 years. In 2020, Sun Summit Berhad shows a noticeably higher debt to equity ratio, which means it was more dependent on borrowed funds compared to Kasum Berhad. This reflects a more aggressive financial strategy. Moving into 2021, Sun Summit Berhad's ratio declined significantly, indicating a major reduction in debt or an improvement in equity. This marks a clear shift towards a safer and less leveraged position. On the other hand, Kasum Berhad shows only a slight decrease across the same period. This suggests that Kasum Berhad maintained a steady and cautious approach to financing, with minimal changes on its reliance on debt. Now we will look at analysis of interest cover ratio for Sun Summit Berhad and Kasum Berhad. The first graph shows a clear weakening trend in Sun Summit Berhad's ability to cover interest cost over time. In 2019, the company was in a very strong position, with earnings far exceeding its interest obligation. However, from 2020 onwards, the ratio dropped sharply and continued to remain low until 2023. Indicates that although Sun Summit Berhad could still meet its interest payment, the safety margin became much thinner, making the company more sensitive to any decline in operating profits. This second graph compares the interest cover ratio performance of both companies over 2 years. Sun Summit Berhad experienced a decline from 2020 to 2021, showing reduced comfort in paying interest from operating income. In contrast, Kasum Berhad moved from a negative position in 2020 to a strong positive ratio in 2021. This sharp improvement suggests a turnaround in operating performance, allowing Kasum Berhad to service its interest expenses much more confidently than the previous year.